Global markets are bracing this week for big rates decisions from the Fed on Thursday and the Bank of Japan on Friday. The Fed is expected to cut, but the Bank of Japan may hike. And New Zealand has a big week of data, with GDP on Wednesday expected to show a triple-dip recession before a rebound next year. That's coming up in our 5 Things in 5 Minutes. And then in the first in a series of bonus deep dive interviews to round out the year that was and look ahead to 2025, ANZ's chief economist for Greater China, Raymond Yeung, expects monetary policy loosening in the first quarter.
For the very first time since 2010, then they changed the wording in terms of monetary policy. They scrapped the term prudence, but replaced it with a term moderately loosening and to describe the monetary policy. So it seems that they really go for a reflation strategy in the first quarter of the year.
But first, in 5 and 5 with ANZ, markets are bracing for a big week of economic data and central bank decisions ahead of the Christmas break. There's a Fed decision on Thursday and a Bank of Japan decision on Friday, which is very much still in the balance, especially after Friday's mixed Tankan business survey results. ANZ FX analyst Felix Ryan says markets have reduced their expectations for a hike by the Bank of Japan to 17% from 60% at the start of the month.
Our view is still that the Bank of Japan will be hiking rates by 25 basis points at the upcoming December meeting. And really that's based off the view that we've seen some solid trends in inflation, particularly the services-related side of things, solid wage growth as well, the prospect for more or stronger wage growth coming as well in 2025, and also some strong GDP and growth figures just generally as well.
Number 2, Felix says the Tankan's measures of labour market tightness were particularly notable.
So the employment conditions index was at minus 36 for all industries, and that's the lowest really since 1991. So definitely suggesting a very tight labour market there and maybe adding some pressure, at least in the eyes of the Bank of Japan, as a driver for wage growth and also potentially inflation too.
Number 3, while Japan's central bank may hike, the trend in Europe is for more rate cuts, as ANZ's head of G3 Economics, Brian Martin, explains.
When you look at the political backdrop in Europe at the moment as well, elections in Germany on the 23rd of February next year, you can't have an election in France before July 2027, and it's not clear that we will have one then as well. There seems to be a bit of an absence of political leadership in Europe's two main economies at the moment, and I think that just adds to onus on the ECB to cut interest rates.
Number 4, New Zealand's economy has a big week of data ahead with selected price indices for November later today, and then tomorrow the Treasury will release the half-yearly update on the government's finances, including expectations of a higher borrowing program. But it's GDP figures for the September quarter on Wednesday that ANZ New Zealand chief economist Sharon Zollner is watching closely too.
That will be an interesting one about whether we've gone into a triple dip recession. But it's early days in terms of what the last quarter of the year could bring. Generally speaking, we've seen a bit of a lift in the high-frequency data, the monthly data, both from confidence to the transport measures through to all sorts of things, job ads, house sales. It really does look like things turned up in the last quarter of the year. So hopefully that will mark a return to positive growth.
Number 5, China's annual Central Economic Work Programme conference finished last week with a summary announcement, which wasn't too surprising, says ANZ China economist Vicky Zhou, given the Politburo statement earlier in the week. But it has firmed up expectations for next year.
The questions ahead will be the size of the measures. We maintain our forecast of a 3.8 deficit, an additional 1 trillion yuan in ultra-long treasury bond, a 30 basis point cut to the policy rate, and a 100 basis point cut to RRR in 2025. As China has recently downplayed its GDP growth target, we expect a downgrade to 4.5 to 5% in 2025. China continues to focus more on long-term structural growth rather than short-term numbers.
Vicky Zhou there. Now, in our bonus deep dive interview, ANZ's chief economist for Greater China, Raymond Yeung, saw China's economy having a 2024 of 2 halves, with the first half in rapid decline and the second half being about stimulus announcements and stabilisation. He says deflation, though, remains a problem.
So on the price front, in China does not seem to have a significant rebound in 2024, even after those stimulus measures. And also, even though we've seen a lot of domestic tourism and household spending sentiment or appetite to spend money seems to have stabilized, but then that has not been fully reflected in the retail sales number. But at least from what we've observed on the ground, that towards the end of the year, the household sentiment and even some of the business sentiment seems to have improved and stabilized. That's how they conclude 2024.
Looking to 2025, what should be the thing on people's radars for China?
Apparently, towards the end of the year, especially in December, government continued to step up and vow to support the economy, in the Politburo meetings, in the Central Economic Work Conference, and they've used the term they will step up with an unconventional counter-cyclical policy to support the economy. And for the very first time since 2010, then they've changed the wording in terms of monetary policy. They scrapped the term prudence, but replaced it with a term moderately loosening and to describe the monetary policy. So it seems that they really go for a reflation strategy, at least I believe in the first quarter of the year. We think that most of this policy will at least help China to stop loss. And I would use 2025, describe it as an L-shaped scenario for the China growth momentum. That is very likely that we see a China economy to bottom. And with some upside risk of growth, even though our current base scenario is still seeing 4.3% GDP growth, youth unemployment remains very, very high. The official number is 17%, at the end of the year. But we think that this number will start to come down. Now, of course, I'm not saying that we will see a strong recovery or strong rebound next year, but at least that I think some of the stimulus seems to be able to support some moderate improvement in sentiment and the financial risk facing China, including the property finance and local government hidden debts. All these financial challenge will not result in any significant blow of the financial system because of the put offered by the government, plus some of the stimulus through the fiscal policy that we see a larger fiscal deficit that will be close to 4%, and our current forecast is 3.8%. So that seems to me that even though we have a base scenario of 4.3% 2025, but from the risk perspective, I'm actually seeing a little bit more upside risk than the downside risk.
And just looking at Taiwan and Hong Kong as part of Greater China, what are their prospects for 2025?
One of the challenges, obviously, that people are still holding a very cautious view about the regional economy, including China, is Trump. And that's got to be a lot of talk about very high tariff rate imposed on Chinese goods that will hurt Chinese export. That's obviously a downside to the China economic momentum. And eventually, along the whole supply chain, that eventually spill over to Taiwan and also Hong Kong, because Taiwan's got a lot of investment in China and still using China as the major production base, despite the relocation to Vietnam and India and other countries in the last few years. But of course, in terms of Taiwan, one good thing is that the islands is the tech center of the world. Has basically all the semiconductor supply chains is centered in Taiwan, and AI development is the ongoing theme that is started to change every people's life, and the corporate tech investment will continue to support Taiwan export, especially for the chip business in Taiwan. So we actually see a higher growth in Taiwan will be between 4 to 5% growth at least in Taiwan for 2025 through the net exports. And as long as the listed company, the major one like TSMC is doing well and that attract a lot of equities inflow to the Taiwan stock market, that will be very supportive to domestic consumption.
Raymond Yeung there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Monday, December the 16th. We'll be putting out the podcast tomorrow, and our last episode for the year will be on Wednesday. We start again for 2025 on January the 13th. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.